Let's also bring on board Mark Konyn, CEO at Cathay Conning Asset Management. He joins us from Hong Kong. Mark, hi, good morning. Good to have you on the show. Firstly, I want to begin by talking about India. You've remained positive on India, but there are two jokers in the pack, like you say. A, monsoon, and B, the oil price spike. How would you approach the market now?
We're still constructive on the market. We're seeing market really trading on about 16 times forward earnings, and probably can justify a slightly higher rating than that, given the expectations of improvements around implementation of policies with the new administration. As you say, the monsoons clearly could disrupt that shorter term, I guess, and create some build-up of food price inflation. And then the great unknown there is the impact that the conflict in Iraq might have on overall oil prices globally. And there are many questions around that. It's difficult to pull apart all the issues at the moment, but clearly any economy that's got either a budget deficit, a current account deficit, or is applying energy subsidies at the moment is going to be more vulnerable in a situation where we see an upward hit on the oil price.
So, Mark, what's the view then in terms of, how the cyclical shift in equities is actually panning out, wherein you are seeing cyclicals overtake the pure defensives, the likes of IT and pharma? Does it seem like this sort of seesaw is going to continue for a while, or do you think if the market were to scale up higher from here, you will see both the spaces actually emerge winners?
Well, I think there's a bias towards the cyclicals at the moment, and that's certainly our stance. Although we're not neglecting some of the other sectors, we are constructive on the IT sector as well, and certain exporters are beginning to show up more in our screens and make their way into portfolios. But immediately it is the cyclicals, it is the sector that is going to benefit mostly from an improvement in economic conditions. We are in the upsurge now of a cyclical recovery in the broader economy. That is being compounded potentially, or will be compounded, by new policies as we start to see some implementation of promised reforms. It's been a long time coming, as we know, in India, and we are expecting the new administration with a smaller cabinet, more decisive governance structure around policy decision making. We do expect to see those forthcoming. However, I would stress that a lot depends as we move further forward, as we get beyond the summer, as we get beyond the honeymoon post-election. A lot will depend on the quality of earnings, and over the next 6 to 12 months that's going to be critical in giving certainly international investors the confidence to continue allocating to India. And India is benefiting from the marginal dollar allocation. The allocation this year is still only around 10 billion US. It's basically in line with averages we've seen over the last 5 years. We do expect to see an improvement in that long-term average as we see the relative attractiveness of the market compared to other emerging markets. And emerging markets generally are in favour again. We are starting to see investors take note of some of those evaluation differentials between emerging and developed markets.
Right. Mark, Indian economy is unlikely to bounce back or come back in FY15. The core thesis is that the Indian economy will bounce back in FY16. So in the short term, earnings will disappoint. In the short term, earnings are unlikely to surprise us. Do you think markets are prepared for that?
Well, I think a lot of what's already been discounted means that the market could support a re-rating, and that is clearly predicated on continued flow of international money, but also domestic investors. As we know, over the past period, the past phase of the progress in the market, domestic investors have pretty much been absent in terms of participating fully. So a lot is built around improving sentiment towards the market. And I think if that's the case, I think the market will justify a higher rating, at least in the short term, until we start to see those earnings come through. But as you say, if there is a disappointment in earnings, which we're not expecting, that would cause the market to pull back a little bit. But I think structurally the stars are aligned for the market, and we're still very constructive. We're increasing our weighting in India, and we believe that to be and see that as structural overweight over the next several quarters.
Mark, what about the FOMC meet takeaways? And it was a rather dovish stance from the Fed this time.
Yeah, mixed, I think. We did see a little bit of a pickup in the inflation numbers. I think the markets really are discounting improved growth, an improved growth outlook accompanied by slightly higher inflation, and are constructive on equities as a result and risk assets. And a slightly dovish comment was interpreted positively as not accelerating the point at which the FOMC, Fed start to raise rates. But I think there are some underlying issues there which will prove difficult to manage. If you look at the overall pace of growth, and the Fed did downgrade its outlook for growth, what we're seeing now is that the US economy, its sustainable growth level, has actually dropped from about 2%, the long-term average, closer to 1.5%. And that probably means that some of the constraints in terms of full employment and capacity within the labour market are already approaching. So there are some prospects now for inflation to continue to be on the radar of the Fed at a time when growth is a little bit subdued, and that is a little bit difficult to manage, as we know. And if we think about real wages, we're not seeing the pressure on wages, although the inflation number was 2.1%. Annually, wage growth is only 2%, so actually wages are coming down in real terms. So a lot is built around a number of different assumptions, but on the assumption that global trade prices continue to be soft and we continue to see deflationary factors at play in the global economy, the Fed probably manage this through. But if we do start to see trade prices move up in dollar terms, then I think we've got a concern that we'll see sluggish growth and rising rates sooner or potentially more increments than is currently being discounted in the market.
Mark, for the moment, all the trading attention, all the world attention is centered around Iraq. But do you think problems in Iraq, when we will look back, they will look transitory in nature? The world has seen Syria, the world has seen Ukraine. Global leaders are in no mood to start a war. So maybe Iraq or the shakeout in Iraq is giving money managers a buying opportunity.
Well, I'd be cautious about that because we haven't really seen the full extent, and we don't know the full extent of how this conflict is likely to play out. I mean, it's true at the moment that the shortfall in supply hasn't been really significant enough to suggest an oil price shock. If we think about where that conflict is, it's been mostly in the north, and most of the supply is in the south, as we know. And depending on how that progresses, it could have a knock-on effect because supply is quite tight at the moment. If you take out, and look at the worst-case scenario, you take out of production all of Iraq's supply, and I think certainly within OPEC, there's insufficient additional capacity to be able to fill that gap. So you would see an upward movement in the oil price. The other aspect, of course, with the oil price is it's incredibly volatile. It's not unusual to see big swings in short periods, even over several days. And that is disruptive. It's disruptive for industries which are dependent on oil, and it's disruptive for economies that are dependent on oil. So there are a couple of positives around that in the sense that certainly here in Asia, economies have become less sensitive to oil prices as a result of more efficient use of carbon fuels, of oil, in terms of the amount of the economy that's dependent. But nevertheless, any upward tick in the oil price is a concern. And estimates believe that for every $10 on the oil price, it costs the global economy about 0.2% on GDP. So that would be a concern. But I think we're a long way from that yet. But nevertheless, I think asset managers are starting to take a look at that. And we could probably anticipate some inclusion of commodities within the basket that asset managers are positioning, or certainly